Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we do post our upcoming live show schedule on aaii.com/webinars, and AAII members do have access to the full archive of shows. I'm joined today by my co-host, Kyler Werf, who you will see in some of these segments we recorded. Our guests today are Derek Hageman, David Goldstone, Matt Bajkowski, and Charles Rupplet. Today's show has three topics. What is a stock split and how do you account for it in your portfolio? The first segment of this episode of the Individual Investor Show, we discuss stock splits and how to document them in the My Portfolio tool, and then discuss recent stock splits featured in the First Cut list. Next, we get an update on Robo Advisers with David Goldstone with back-end benchmarking, publisher of the Robo Report. Finally, AAII finance writer Matt Bajkowski shows us how to make the most of the My Screens area on AAII.com to see which stocks pass the strategies you follow and drill down for more information. Plus, our listener mailbag segment where we answer listener submitted questions. Let's get started. Derek, the premise of this segment is what is a stock split and how do you account for it in your portfolio? Walk us through this concept.
Yeah, sure, Ryan. Well, let's see, where can we start? Stock splits and stock dividends, I mean, they're often announced with great fanfare, strong press coverage, but really what a stock split is, it's a decision by a company's board of directors to reduce the prevailing stock price by increasing the number of shares that are outstanding. So, and I'll get into the concept in a second, but after a split, the stock price is reduced since the number of shares outstanding has increased. So although the number of outstanding shares increases and the price of each share proportionately decreases, the company's market capitalization, it actually remains unchanged. And just a reminder, market cap is the stock's price times the total number of shares outstanding. So if we just look at the accounting treatment of stock dividends and splits, they're slightly different, but for the investor, stock dividends and stock splits, they're identical except for in magnitude. So stock dividends, they are distributions of additional shares of stock to shareholders instead of cash. So for an investor holding 100 shares of a stock, and let's say a 5% stock dividend, that would entitle the investor to another 5 shares of stock. When a stock dividend is over 25%, they're typically called splits. So a positive stock split or dividend partitions the outstanding shares of a corporation into a larger number of shares, accompanied with a proportionate decrease in share price. So without affecting the overall shareholders' equity or the total market value. So just, it might help if I give a quick example. Let's say a company declares a 2-for-1 stock split. That would be a stock ratio of 2.0. And let's say you own 100 shares and each of those shares is priced at $50 per share. So the total value would be $5,000. Well, once the split occurs, you would actually hold 200 shares at that point, but the price of each of those shares would be $25 per share, but the total value would remain the same at $5,000.
Okay, so now that we know the basics of what a stock split, let's get into part two, which is accounting for one. You kind of touched on this a little bit. AAII, of course, has the My Portfolio tracking tool. Can members track stock splits using it? And are there other AAII-wide available resources on stock splits?
Yeah, no, good question. Before we get to the AAII resources, I think it's important for everyone to know, there are some important stock split dates. And when a company announces a stock split, it provides 3 important dates for shareholders. One is the record date. The second is a split date, and third is an X date. And the record date determines which shareholders are entitled to receive the additional shares due to the split, And on the split date, that's when the shareholders receive the split shares after the close of business. And this is probably the most important date, is the X date. That's the date when a company's shares will trade at the new split adjusted price. So you must hold the stock at the close of business on the record date to be eligible for the split. And while the actual split itself and the adjustment to the number of shares in your account, it actually will take place on the X date. So now just to go back to your original question, you asked, can AAII members track stock splits using my portfolio? And are there any other AAII-wide resources to track stock splits? So definitely the answer is yes. AAII members can see stock split dates and ratios on the charts tab of the stock evaluator by choosing splits from the events drop-down menu just above the chart. Another resource to track stock splits is if you're using AAII's Stock Investor Pro, which is the fundamental stock screening and research database that we have at AAII. And in Stock Investor Pro, if you enter a ticker and then pull up that ticker, next what you would do is you would click on Share Statistics, which is a sub-tab in the overall section, or excuse me, in the overview section. And in that sub-tab, the Share Statistics, there's a section that lists some of the share information like shares outstanding, split date, and split factor.
So we're always generating stock ideas at AAII headquarters, and stock splits, it sounds like, are yet another opportunity for investors. For a recent first cut list, you did highlight some recent stocks that underwent a positive stock split. Why did you look at this, and what stocks exactly did you find here?
Yeah, no, that's correct. We created a first cut list article. It was actually called Karate Chop, Recent Stock Splits. And one thing we like to do at AAII is we just like to look for trends. And so in this case, we wanted to look at stock splits to see if more companies were doing stock splits, and if this information could give us insight into overall stock valuations. For example, so why would a company do a stock split? Well, one reason is that many companies, they generally like to keep their stock's price per share within a certain range. And when a company's share price increases to levels that it believes is too high, that's when they may decide to do a stock split. And the reason for this is that a stock split can make shares seem more affordable to small investors, even though, again, just a reminder that the underlying market value of the company hasn't changed. But this also might be a practical effect of increasing liquidity in the stock. But why did we do the first cut article? Well, 6 months ago, we did a similar article, and we actually found a similar number of companies passing the screen. And this time, we found 25 companies passing the screen, and really from a diverse set of industries such as banks, software, electronic equipment and parts, and food processing, just to name a few. And some of the companies that passed the screens included Sherwin-Williams, ticker SHW. There was another one, Amphenol Corporation, ticker APH. And a third one, again, just to name a few of the stocks that passed, McCormick and Company, which is ticker MKC. You're probably familiar with them. They produce a lot of spices. So what we did is we wanted to look and see if there was any trends. And really what it told us is that not much has changed over the last 6 months. We still had the same number of companies passing this particular screen, a similar set of diverse industries and companies.
You talked about some of the dates related to stock splits. What would be some considerations here with investing in recently split stocks? Is this a case of, divide and conquer, or two halves making a better whole? I guess, for the investors watching and listening to this, why would they go to this list?
Yeah, sure. No, I mean, while stocks can see their share price rise after announcing a split, it's important to realize that splits usually follow a period of strong price performance, and companies announcing splits, I mentioned this earlier, they really do seek to keep their stock price from getting too high. A stock split announcement represents a vote of confidence from the board of directors. It acknowledges that a company's stock performance and signals that the board feels performance is going to continue. So those are reasons to pay attention to a first cut list like this. But it's also important to keep in mind that a stock split is not necessarily a reason to buy a stock, but it really serves as a pointer to recently successful stocks that may be attractive if the fundamental factors that fueled the performance remain good.
As always, be cautious and be careful. If you'd like to learn more about the mechanics of stock splits, I recommend that you check out Derek's article. It's titled AAII How to Stock Split or Not to Stock Split. And then if you're interested in the follow-up stock split focused first cut list, as Derek mentioned, his article is named Karate Chop Recent Stock Splits. Excellent title. Both are available in the June 2021 AAII Journal, available in the print edition and on the website AAII.com. Thanks again, Derek.
Yeah, thank you, Ryan.
Robo Advisors are now looking beyond investment management to banking and various other services. This is the opening statement of a recent article from Ken Shapiro, who is the founder of Backend Benchmarking, which publishes the Robo Report. With us today is the manager of research and analytics at Backend Benchmarking, David Goldstone. Welcome to the program.
Yes, thanks. Thanks for having me here.
As was noted in the article, Robo Advisors came to be in the wake of the 2008 financial crisis, and roughly over a decade has passed since they were first created. You've been following them. What has changed in Robo Advisors since then?
Yeah, absolutely. First, when talking about Robo Advisors, what started as a niche product offered by a few startups has been adopted across the industry. Now, the major national banks, discount brokerages, and wirehouses almost all offer some type of robo advice product. What that means for the individual investor is that you're likely already doing business with a financial institution that offers robo advice. Individual investors will increasingly be offered or presented with these products, so it's more important now than ever that individuals understand what these products are and what they can expect from them. Second, robo advice in its original form was a digital-only experience, meaning that the experience was online only and there's little to no access to live advisors. This is no longer the case. Now, nearly all providers offer some type of access to live advisors or a service level that offers live planning and advice. With the popularization of this so-called hybrid model, there's a wide variety of the level of service investors can expect from different providers. It's important individuals understand if the live representatives are primarily there for customer service and operational support, or if they are trained advisors or planners. It is both important for the individual to know what type of live support they want and what the provider offers. Third, when talking about some of the original independent robo advisors like Betterment and Wealthfront, they now offer a wider suite of services, specifically banking. Now an individual can manage their spending, savings, and investing at one of these startups. The expansion into banking by robo advice platforms is definitely one of the largest trends I've seen in the industry.
I want to turn to financial planning, which you mentioned there, because it seems like, after the pandemic year we've all had globally, I'm seeing a lot more commercials and ads from major banks and investment firms for these apps that are touting better ways to plan your future. I didn't realize the robo connection here. Why did this happen? And is there something for the everyday individual investor in these apps and services truly?
Yeah, I mean, there definitely is something for individual investors in these apps and products. I definitely think they are, generally speaking, they're very good products and they're appropriate for individual investors. One of the largest impacts that these products have had on the industry is both expanding access to individuals, specifically younger demographics and those with less investable assets. So there's a lot more accessibility out there for somebody who doesn't have a real large investable portfolio yet. When previously, most advisors are looking for clients with a minimum of $250,000 or less. So I think that's one of the, that's one of the biggest things that's happening in the industry. Now just $1 is enough to start an investment account on some of these platforms. I think one of the things that's happening is lowering both the logistical and the behavioral hurdles to start saving and investing is great for the individual. Starting saving and planning at a young age can lay the foundation for successful long-term planning. The increased access to both professionally managed portfolios and also the financial planning tools or live financial planners is really great for the individual. Also firms are transitioning their customer acquisition efforts to earlier in the client lifecycle. I think is why you're seeing a lot of these ads and a lot of the publicity, kind of around it, the paid publicity around it. Going forward, many individuals will already have a professional investing relationship in place through some type of robo-advice product by the time they reach their 30s and 40s and are in their prime wealth accumulation phase. The mass transition to handling a variety of tasks from home, I think, has also been a tailwind, through the pandemic, been a tailwind for robo-advisors, which, are really natively built to manage relationships and investing online. So.
I wanted to ask off of that about fees and performance. Ken wrote that, quote, possibly the largest effect that robo-advice has had on the financial advice industry is a redefinition of low-cost portfolio management, end quote. What does low cost mean here? And as a follow-up to that, is there a trade-off in performance for the low fee? I can't imagine robo-advisors, which usually involve passive portfolios, being as lucrative on this front as, say, an actively managed portfolio.
Yeah, sure. So let me first kind of define what we mean by low fees. Generally, for a digital only product that has limited or no access to live advisors, investors should be looking to pay 35 basis points, 0.35% or less. For a program that includes access to live advisors, as quality live advice and planning, I think a good price point is like 0.50% or less, which is drastically different than the typical 1% or more than 1% that traditional advisors often charge. So it's a significant step down in fees, signing up for one of these products. That wasn't really possible, definitely not possible for people with lower assets in the past, previously, historically speaking. Regarding performance, one of the largest determinants of long-term portfolio performance is fees. That's been well documented. Additionally, passive management and low cost like index portfolios historically perform pretty well. You don't necessarily choosing indexing and passive management certainly does not necessarily mean that you're choosing a lower performing portfolio. We all know that active management doesn't necessarily mean increased returns. Active managers as a whole are pretty notorious, as you probably know, for underperforming benchmarks and struggling to beat indexes.
Sure.
So the whole active bet, that's been a long-term trend to this transition to more passive and more indexing, and for good reasons, based in performance as well. So I don't think it's a clear trade-off being in an index portfolio versus performance. I think especially if you're looking at individual investors who are really focused on long-term goal planning and goal achievement, low cost, globally diversified, passive portfolio is a good, very appropriate option for that type of investor. A lot of the behavioral shortfalls that individuals are kind of notorious for, performance chasing, timing markets, getting into complex or trending investment strategies, these can all pose real risks to investors. So robo-advisors providing, a certain amount of discipline, professional management, low cost index portfolio, I think is a good thing and totally appropriate for most individual investors. In short, I don't think their investors are paying a significant performance premium by paying a low fee at a robo-advisor. One other note, while most providers use passive low cost indexed approach, that's a vast majority of the portfolios we see. There are a couple out there that have some more active options. Like Morgan Stanley, for example, offers a variety of theme portfolios within their robo-advisor. Those rely on some active mutual funds. Some of them have done really well, like the robotics portfolio, themed portfolio there has had pretty fantastic performance. And then I'll mention another, Titan Invest, which is a much smaller, kind of independent, more niche robo-advisor. That's an active option, and they've done quite well over the past 2 years. So for those out there seeking a more active approach, there are a few options, although a vast majority of the portfolios are, low cost indexed.
Turning to this year, I realize we're kind of towards the end of Q2 of 2021. What have been the factors driving the better performing robos out there? Are there highlights so far for those investors who are, perhaps let's call them robo inclined?
Yeah, absolutely. So, like anything with performance, it really depends on the time period you look at. For the past 5 years, and either further going back in the markets, growth stocks have significantly outperformed value stocks. And that's driven a lot of kind of the performance in the underlying, in the portfolios of different robo advisors. Excuse me. Has really driven the performance in the equity side of a lot of these portfolios. An interesting thing you see in the portfolios is you see a lot of portfolios that are tilted towards value and a lot that are neutral on the growth value. You see very few, if any, that really have that growth tilt. So really, when talking about this trend of growth really outdoing value, the ones that have done well have really neutral portfolios on that front, because there just aren't that many that have a growth, a growth tilt to them. Specifically, SigFig and Vanguard are both examples that they have really straightforward portfolios, and they've been real strong performers, kind of looking back at the 3-5 year time frame. When turning to 2021 specifically, that trend reversed. You've got a lot more value significantly this year. In the fourth quarter last year, significantly outperformed growth. So some of the ones that were lagging because they had value tilts on them have definitely caught up and have done really well this year. I'll highlight Schwab and Betterment both have done very well in 2021 because of that. On the fixed income side, portfolios that are taking a little bit more of a risk on approach have more corporates, have some high yield, although there are definitely periods last year that those areas struggled. The little bit more risky bond portfolios have done well. Again, Schwab is like a highlight there. They definitely go out a little bit on the risk on side as far as international bonds, some high yield, some other stuff in that portfolio. One other interesting performance trend that we've witnessed is within these socially responsible investing portfolios. They became really popular for robo advisors to offer, an SRI or an ESG type portfolio. We've tracked a bunch of these portfolios where they're offered. And although you can expect to pay a little bit more in the underlying fund fees for those portfolios, we have not seen really any type of performance premium you're paying to be in an ESG portfolio. So I think that's pretty interesting. And I think there's increasing interest kind of across the individual investor landscape in these type of impact socially responsible portfolios. And I think it's a good sign that these portfolios, it does not appear, we still have a relatively short time period, just about 2-3 years at some of them. But we have not seen a significant performance premium, and they're very frequently outperforming, even net of fees, their index kind of regular counterparts at the same provider. So.
Last but not least, and you just, pointed to some of these trends, I'd like to ask you to predict a little bit what the future holds for robo advisors. As you said up at the top, the headline grabbers in investing over the past year have been tied to digital initiatives. And I'll name a few: Wall Street Bets, Robinhood, various cryptocurrencies. And I'd also be remiss not to mention the consolidation of the investing world. For example, the Schwab TD Ameritrade merger. In this kind of landscape going forward, where do you see robo advisors in that mix of products?
Yeah, so I think there are a couple big things going on here in the industry in general. Robo advice is now clearly a permanent part of the investing landscape. It's here to stay. All the major firms, most of the major firms, offer some type of robo advice product. It's going to be around in the future. This is not a fad or trend that's going to fade. I think due to wider accessibility of professional management, there are more individuals participating in markets in earlier stages in their life cycles. I think that's one of the big trends that has started and will continue, is that a lot of investors have a relationship in place much younger. Like just the average age of an investor, I think, is falling and will continue to fall. I think that's great for individuals to start investing earlier, to set these habits at a young age, et cetera. Also, I expect to continue to see the launch and improvement of digital planning tools. There have been a couple kind of big planning tools that have come out. Some of the independents, Betterment has a good one. Wealthfront has a very high quality one. I think the access to financial planning, these tools, these online tools being used, being marketed more, being improved, being launched to places that don't have them. I think that's another kind of bigger trend just accessibility. You know, the first step was kind of accessibility to professional asset management. Step number two is really, you know, accessibility to financial planning. I think that's a real positive trend. I think we're going to continue to see more of that, you know, a greater part of the population having some kind of financial plan in place, which I think is also, I think is great for the individual. As far as really what's next, you know, I think the next wave of innovation we will see is the automation of other personal financial tasks. Specifically, I'm talking about the automation of personal cash management. We've already seen some early innovations in this area. Specifically, Wealthfront's self-driving money product is pretty interesting. But I think we'll see more of that. You know, more of this automation of your day-to-day spending and saving, kind of helping you automate and streamline and optimize all the way from, you know, the day you get your paycheck to your long-term goals, kind of creating more services to handle that entire process. So I think I'm excited to see what comes out kind of next there. I think it'll take some time to really get some really helpful automation around that area. It's pretty complex, but I think that's where it's headed, kind of more mid to long term. I expect to see more of that. I think there are also some interesting things that are going on that we'll start to see kind of what their final form is around direct indexing, which does a couple things. It allows you, you know, that's where direct indexing in general is where you own all of the underlying of an index, as opposed to buying, you know, you own every stock in the S&P 500 as opposed to buying an S&P 500 ETF or mutual fund. So it allows you to possibly cut out the mutual fund, which is interesting. But I think much more interesting is it allows for a lot more customization. So specifically, one of the use cases is around this ESG SRI investing. If you want to screen out certain types of stocks or specific companies or specific industries, you can track an index, but then also screen out kind of individual companies from that using some direct indexing technology. I think that's not, there are some providers out there that have some types of, you know, direct indexing stuff going on. Wealthfront, Personal Capital, Interactive Brokers are like three that come to mind. But really the final form of those products, I think we'll start to see a lot more of that and some interesting stuff down there.
Well, thank you for answering my questions and for your comments, David. If our listeners and viewers are interested in following your work, you know, where can they find you? This is your chance to plug yourself.
Yeah, you bet. So we provide the Robo Report for free. It's really in depth. It's got performance of 41 different providers, 90 accounts. You can get it for free at backendbenchmarking.com. It's backendbenchmarking.com. You just have to subscribe to us. And also throw out there, we're developing a personal finance platform, an app to help individuals see all their accounts in one place and help people analyze and optimize their investment accounts. It's not live yet, but on the website, you can sign up for the beta, for the digital advice beta. So I encourage you to do that as well. Pretty exciting stuff.
And meanwhile, if you'd like to learn more about recent updates in Robo Advisors in more staid form, you can check out David's colleague, Ken Shapiro's article. It's called Robo Advisor 2021 Innovations and Performance Drivers. That's available both in the June 2021 issue of the AAII Journal and the print edition and on AAII.com. Thanks again, David.
Thank you so much, Ryan.
To help focus your research on the screens and stocks that most interest you, AAII offers its members My Screens on our website, which provides several different ways to compare the screens and allow you to favorite screens you would like to follow. Today, I'm joined by Matt Bajkowski, financial writer for AAII and author of the My Screens Tracker article in the June Journal to talk about My Screens. How are you doing today, Matt?
Hey, Kyler. I'm doing well. How are you doing?
That's great. I'm doing wonderful. So what are My Screens?
Yeah, so as an AAII member, My Screens is your personalized tracking list of stock screens or strategies and the stock ideas they generate. The My Screens tracking table allows you to easily compare the strategies, and you can get to it by going to the screening webpage at AAII.com, or you can directly get to it at AAII.com/stockideas/MyScreens.
What tools and information are available on My Screens?
Yeah, so the My Screens tracking table has 5 tabs. The first 3 deal with the screens that you're following. The first tab, Stocks Passing My Screens, shows which stocks are passing the screen as of the last trading day and their characteristics. Now we call these characteristics, and they include ratios such as price to earnings and price to sales, and also such things as the dividend yield and the market cap. The second tab features the stock grades for the same list of passing screens. And the third tab has individual screen performance. Now, this is monthly. The last two tabs of the My Screens tracking table deal specifically with stocks. If you're following any stocks through AAII's My Portfolio tool, those stocks will appear under the list of My Stocks passing any screens. It ranks in descending order the number of screens that the stocks you follow are passing. In the last tab in the My Screens table, it looks at AAII's entire stock universe, which is about 6,000 stocks. And this last tab pulls together any stocks that pass at least 2 screens. And these are also ranked in descending order. As of the time we're recording this, Dick's Sporting Goods and Medifast are leading. They're both passing 8 screens currently. In total today, there are 405 stocks passing at least 2 screens.
How can AAII members utilize the factor screens?
Yeah, so factor investing chooses stocks based on attributes that have been shown over time to generate high returns, and these attributes are known as factors. So some factors include small stocks, low valuation, high price momentum, and high yield. So we have developed several screens that are based around these common investment factors, such as the dividend high relative yield screen or the value on the move screen. So if you're specifically looking to invest along one field or one factor, you want to use the factor screens.
And how can AAII members use the Guru screens?
Right. So the majority of our screens are Guru screens, and what we mean by Guru is basically an idol of investment philosophy, such as Warren Buffett, Benjamin Graham, Peter Lynch, or William O'Neill. These guys used a lot of them used factors, but these Guru screens particularly are focused on their personal investment philosophy. So, Warren Buffett is associated with the basic principles of fundamental investing, which begins with an understanding of the value of a business, and then determining if the current stock price presents an attractive buying opportunity. So we have 3 Buffett screens that are based on Buffett's investment philosophy that starts from those basic principles. And also we have a few stock screens based on Benjamin Graham's approach, which really focuses on the concept of an intrinsic value, which hopefully is justified by a firm's assets, earnings, dividends, and financial strength. And if you want to get into the background of each Guru screen, you can see that at each individual screen's webpage.
How are grades determined for each factor and Guru screen?
Yeah, so the A+ stock grades are based on percentile ranks. So we look at every stock in the AAII stock universe and assign it a ranking over 5 factors, which are value, growth, momentum, estimate revisions, and quality. Each factor is also a composite of multiple metrics. And then the grades use an A through F system. So A is very strong or very positive, and F is very weak or very negative.
How often is the information for My Screens updated?
Yeah, so the stock data is updated daily, and this also includes any passing company lists. These are through the last full trading day. So today, as we're recording this, the data is through Monday, June 7th. Screen characteristics or stock characteristics are also updated daily, as well as the grades. And then what really differs is that screen or strategy performance is updated monthly.
How can you highlight the stocks you are interested in on My Screens?
Yeah, so in the last 2 tabs of the My Screens tracking table, if you want to add a stock to the list of an existing portfolio or new portfolio that you have in My Portfolio, click on the yellow plus to the left of the company name. A box will pop up and show you if you have already added that stock to one of your portfolios. And if you want to follow any of the stock screens, look for the star that appears next to the name of the screen itself in several places across AAII.com. The star will appear yellow if you're already following the screen. Otherwise, just click on the star to start following. There's an option to follow a screen. It's available on the Screen Power Rankings page, the Guru Screens, the Guru Screens page, and the Factor Screens page as well. And again, you can get to these pages from the Screening tab at the horizontal menu bar at the top of AAII.com.
Thank you so much for your time. Again, you can find Matt's article and many others like it on the AAII Journal at AAII.com. Thank you, Matt.
Thanks, Kyler.
And now for our listener mailbag segment, where we address questions that have been submitted by viewers and AAII members and answer them here. If you have any questions for us, you can submit them using the questions panel in your GoToWebinar control panel, or email Ryan at reeha@aai.com with the subject line II show question. All right, Charles, these questions came in and we wanted to have you answer them. This first question comes from Howard Foster. He asks, can any case be made for buying bonds or bond funds in today's market?
Thanks, Kyler. That's a great question. I realize a lot of members are concerned about inflation, concerned about interest rates. And it's a couple of things I would say. First of all, this really ties back into PRISM, our wealth building process. Think about your allocation and think about your goals. Are your goals long-term, where you're really trying to maximize the growth of wealth? Or are your goals shorter term, where you're concerned more with preservation of wealth? Bonds do two things. They provide a ballast against the volatility of the stock market. So if you're concerned about preserving wealth, bonds can actually do that, particularly if you buy individual bonds or you buy defined maturity bond funds, which have a set maturity. If you hold them to maturity, you will get the face value of those bonds back. Or in the case of the defined maturity bond funds, you'll get the net asset value of that bond fund back. The other thing is they do provide income. And granted, yields are low right now. They're painfully low, but that stream of income can help you fund withdrawals. It can also help you avoid selling stocks during downturns. And on a related note to this, I recently read a study that was talking about the importance of having cash savings. And they found out that just having $2,500 in emergency savings in cash really reduces the risk of incurring financial distress, of really having financial problems. Now, many of our members have far more of that in wealth, far more of that in cash, but it goes to show the importance of having interest-bearing safe assets, even during periods where yields are painfully low and people are concerned about the direction of interest rates. And finally, I would just like to add that we really don't know what inflation is going to be like 2 years from now, 5 years from now, 10 years from now. So even though you might have inflationary concerns right now, realize we don't know what interest rates are going to be in the future. And if you don't know what the future is going to be like, you need to be careful about making big bets on outcomes that are uncertain.
Thank you. And the next question comes from Laurie Adams. They ask, instead of an individual investor trying to rebalance a portfolio, what would happen if that person invested in a top performing no load asset allocation fund, 60/40, like Fidelity Balanced or Puritan or Vanguard Star? A cash reserve to supplement living expenses could be kept at either of these companies for ease of financial management.
That's a great question, and it's actually a multifaceted question. So the allocation fund she's discussing, and really allocation funds in general, a group that includes target date funds, those are designed by their objectives to rebalance automatically on a periodic basis. So when you hold those funds, you don't need to rebalance because they do the rebalancing for you. However, if those funds are not your only holding, say you own other mutual funds that are not allocation oriented, or perhaps you're supplementing them with individual stocks or maybe individual bonds. And then you need to look at your overall portfolio and determine whether or not your portfolio has strayed too far from your target allocation and really has perhaps taking on too much risk or not enough risk relative to the allocation that's appropriate relative to your goals. The other thing to consider when you look at that cash allocation, Jim Clunan, AAII's founder, in his level 3 withdrawal approach, actually suggested a form of rebalancing. So the level 3 withdrawal approach calls for having most of your portfolio in equities and then also having a safe bucket, which is really cash savings of 2 to 4 years in expenses. And what Jim proposed is that whenever you tap that cash bucket, which is typically during periods when the market is down, after the market rebounds, you want to actually pull money out of the equity portion of your portfolio, your riskier part of your portfolio, and refill that cash bucket. So if you are maintaining a cash bucket, you still want to make sure you periodically do a form of rebalancing, meaning replenishing the cash bucket so you have an adequate level of cash in it. Maybe it's 1 year's of withdrawal. Maybe you're following Clunan's advice of 2 to 4 years of withdrawals, maybe perhaps a little bit longer. Whatever that cash bucket is, you still need to do a form of rebalancing, but instead of being a very massive form of rebalancing your whole portfolio, you're just taking those small steps to make sure you have adequate levels of cash in that cash bucket.
Thank you so much. Thanks for those questions. Again, if you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel or email Ryan at rreeh@aaii.com with the subject line II show question. We will get them on air for the next II show. Thank you, Charles.
Thank you, Kyler.
If you liked our show, please visit aaii.com/webinars to register for more webinar and video content. You can like us on Facebook, and I invite you to follow us also on Twitter at @AAII_invest_ED. For more investing education, we invite you to check out our website, aaii.com. Again, I want to thank our guests, Derek Hageman, David Goldstone, Matt Bajkowski, and Charles Rupplet, and of course, my co-host, Kyler Worf. And you for listening and watching. We'll see you next time.